Hi everyone, I am Dr. A. Nagalakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNS Rajalakshmi College of Arts and Science, Autonomous, Coimbatore. I am here today to explain a topic, problems of financial regulations in India. So this comes under the course International Financial Law. Under this, large unpopulated population and bank dominated financial sector. So first we should know what are the challenges under this topic. So the first challenge is financial exclusion. The second one is the heavy reliance on banks, and third one is the underdeveloped capital market and insurance penetration. So financial exclusion means normally the people from rural areas does not have the access to the formal banking services, whereas it is vice versa in case of urban areas. The second challenge what we saw was heavy reliance on banks. So normally we have a thought that if we invest, if we are having some pool of money and if we want to make a deposit, so bank is a safe one. Bank will give normal returns. Like that we will have a thought. Then if we want to lend the money, we will go for banks to lend the money as a loan. Okay, so the financial system is overly dependent on commercial banks for credit, savings and payment systems. The last one what we saw is underdeveloped capital markets and insurance penetration. So in India we have more rural areas where they does not know what is meant by a capital market, and insurance penetration is very less. Okay, these are the challenges faced by the large large people in India. Now we are going to see what are the implications. Limit credit access for SME, small medium enterprises and rural entrepreneurs. Next one is encourage the use of informal finance, often at exploitative interest rate. So they does not have the access of bank, they does not aware about the process for lending loans from the banks or from financial institutions, so they go for informal finance with higher interest rates. Next is the hinder inclusive economic growth. Hinders inclusive economic growth. So that is, they does not know how to get the credit, the loans for the small medium enterprises. They does not go for banks or financial institutions, and rural entrepreneurs does not know anything. They cannot access for credit. Then informal finance is playing a role in rural areas. So it hinders the economic growth of the country. Next is policy initiatives. What are the policy initiatives? So here the government has introduced many that is new schemes for this, like Pradhan Mantri Jan Dhan Yojana, digital payment infrastructure. So here we play in urban areas, even a small street vendors and the road side vendors, they are having UPI. So no one is using cash in the hands. So all the transactions are made through QR code. Okay, next is financial literacy programs. Financial literacy programs, that is, it often offered to the rural people, but the rate of the success rate is not that much expected. Next is multiplicity of regulators. So we have many regulatory that is regulations in India for making proper channel. RBI is there for central banks and regulators for the banks. So RBI governs all the banks, NBFCs and payment systems. Likewise, SEBI, Securities Exchange Board of India, it regulates the securities market. It acts as a securities market regulator. IRDAI, insurance sector. PFRDA, this is for pension regulation. Ministry of Finance, overall policy directions. State government and SROs in cooperative banking. So these regulatory regulatory bodies are there to regulate banking sector, financial institutions, insurance sector, everything. What are the issues arising? That is regulatory overlap and turf wars. Arbitrage opportunities. That is firms exploiting gap between NBFC and bank regulations. Slow regulatory response to financial innovation. So here the government employs more regulations. So a normal people cannot normal people cannot go and access for anything and do the process. Next is the conglomerates and virtual firms. What is this? A financial conglomerates, that is large business house with arms in business, insurance and asset management and broking. So financial conglomerates means it is we say they have given an example, right? Reliance Group is there, Bajaj Group is there, where they provide banking services, insurance services, they provide asset management services and broking services. Next is the virtual firms or fintech. Virtual firms, technology driven financial firms, example, payment banks, digital lenders, crypto platforms. So here that is virtual firms means it does not have any place. Through online we have to do all these. Through technology we have to do the financial services. That is the firms where it operates through technology. Okay. Next, operates outside traditional regulatory framework or struggle multiple ones. These are the virtual firms of fintech. What is the risk involved? Systematic risk from interconnectedness, lack of consolidated supervision, consumer protection and data privacy challenges. Yes, systematic risk from interconnectedness. We cannot say the risk occurs from it. While making UPI, if we make a simple change in the UPI, the amount will be credited to someone else. Sometimes amount may be debited, but it will not be credited. Lack of consolidated supervision. So, what to say? Lack of consolidated supervision means we can see the population is more. We cannot expect the supervision, but government is trying to regulate everything. Next is consumer protection and data privacy challenges. So consumers has to be protected because it's a finance related one, and data of the consumers has to be protected because we are saying that there are more cyber crimes, that is amount will be taken by various ways from the consumers. Next is a financial risk, stability and regulation. So financial risk include credit risk, market risk, liquidity risk, operational risk. So credit risk counterparty default. Market risk means the price, interest rates or fluctuation is not fixed. Liquidity risk means inability to sell or raise funds. Operational risk means failures in inter-system and process. So these risks has to be, or that is, it is often that is faced by the people in India. Next is stability concern. Too big to fail institution. Yes, if the finance is more, then there is a situation, there is a possibility of failure to the institutions in raising funds. Shadow banking and unregulated sector. Yes, unregulated sector, which there is no regulatory bodies to regulate these things. Next is regulatory tools. What are the regulatory tools? So in order to overcome the financial risk, there are regulatory bodies. Okay, so regulatory tools to be adopted. One is capital adequacy requirement. Next one is liquidity coverage ratios. Third one is resolution mechanism for failing institutions. So capital adequacy requirement, it is compulsory that the company has to maintain enough capital in order to run a business, to meet the expenses and day-to-day requirements. Liquidity coverage ratio means the company should have 2:1 ratio. That is, asset should be in two portions and liability should be in one portion. So that if the company is going to face the liquidity that is winding up, they are able to make the settlement for all the people, all the creditors. Next one is the resolution mechanism for failing institutions. Resolution mechanism means, what is the resolution mechanism? Resolution mechanism means if a institution is going to face the failure, they should have a mechanism in order to find a resolution. So resolution mechanism has to be handled by the institution for overcoming the failure. Presence of non-banking financial companies, NBFC. So the role of the financial intermediary is, what is the role? So in consumer finance, rural lending, less stringent regulations compared to banks. So cater to niche market like MSME, that is medium, small and medium enterprises. They need the fund to run their business because they are one of the source for economic growth. They has to be properly guided by the banks or financial institutions for their growth and proper running of the business. So what are the concerns? Liquidity mismatch. Example, infrastructure leasing and financial services limited crisis. That is, liquidity mismatches. Liquidity mismatches means they should be strong enough in order to liquidate their assets. Shadow banking risk. Need for better risk management and oversight. These are the concerns. What are the recent reforms? RBI has introduced a scale-based regulatory framework for NBFC. RBI, that is Reserve Bank of India, they have introduced a regulatory framework for non-banking financial corporations. Next one, what we are going to is disparate set of laws governing financial sector. So financial sector is governed by some rules and regulation and some law has been created, introduced. What are those? They have given some examples. Banking Regulation Act 1949, RBI Act 1934, SEBI Act 1992, Insurance Act 1938, SCRA Act 1956, Companies Act 2013. So these are some of the regulatory bodies governing the financial sector. What are the problems faced? Overlapping provisions, gaps and inconsistent standards. outdated provision, not suited to modern finance. Difficulties in inter-regulated regulator coordination. These are the problems faced. Next one is the financial sector, that is Legislative Reform Commission, FSLRC. Financial Sector Legislative Reform Commission. So it was established in the year 2011 under the Justice B.N. Sri Krishna. So B.N. Sri Krishna is the justice. He established this commission, tasked with reviewing and rewriting financial sector laws for a modern globalized economy. So the olden laws and regulations cannot be adopted for the current and modern globalized economy. So this commission was formed in order to review and rewrite the financial sector laws. They have modernized. They have given more inputs to the law. What are the key recommendations of this commission? Unified financial regulatory architecture, RBI focus on monetary policy and systematic risk, creation of a unified financial agency for all non-banking finance solutions, establish a resolution corporation for failing financial firms, introduced an Indian financial code to replace multiple laws, enhance consumer protection and ensure regulatory accountability. So these are the recommendations given by that commission. What is the status? IFC not yet adopted, but some ideas influenced. Insolvency and bankruptcy code was established in 2016. I think I have explained some problems that are faced by the financial institutions, and I have given some inputs regarding the law or the regulatory bodies governing the financial institutions. At last, we have seen the Financial Sector Legislative Reforms Commission formed for the benefit of current globalized economy. Thank you. Thank you so much for your patience listening.